You know what keeps me up at night? It's not the charts. It's not the data. It's the eerie silence before the storm. And right now, silver is sitting in that exact same silence we saw in early 2011, right before it exploded from $18 to $49 in less than 4 months. I'm talking about a 172% gain in 120 days. And the setup we're looking at today? It's not similar. It's identical. Let me take you back to January 2011. Silver was trading around $27. Gold was at $1,400. The mainstream media was calling precious metals a bubble. Sound familiar? CNBC had analysts on every day saying the rally was over, that smart money had already exited, that retail investors were about to get crushed. And you know what happened next? Silver went parabolic. It hit $49.82 by April 28th. That's an 84% move in less than 4 months from that January level. But here's what nobody talks about. The real move didn't start at $27. It started at $18 in August 2010. That's when the technical setup completed. That's when the smart money started accumulating. And by the time the mainstream caught on in March 2011, the easy money had already been made. The question you need to ask yourself right now is this: are we in August 2010 or March 2011? Because the answer to that question could be worth hundreds of thousands of dollars. Let me show you what I'm seeing. Silver just broke out of a 13-year consolidation pattern. 13 years. Do you understand what that means? This isn't some short-term technical bounce. This is a generational setup. The last time we saw a consolidation pattern of this magnitude was in the late 1990s, right before silver went from $4 to $21 between 2001 and 2008. That's a 425% gain, and the pattern we're seeing now is even more compressed, even more coiled, even more explosive. The weekly chart is showing something I've only seen twice in my career. We have a massive cup and handle formation that took over a decade to form. The cup formed between 2011 and 2020. The handle formed between 2020 and 2024. And in November 2024, we broke out. Not a fake breakout, not a head fake. A legitimate, volume-confirmed, institutional-driven breakout above $32. And here's the kicker. After the breakout, we pulled back to retest the breakout level. That retest held. That's textbook technical analysis. That's the setup that precedes massive moves. But let me show you something even more compelling. The gold to silver ratio. Right now, it's sitting at 84 to 1. That means it takes 84 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. During precious metals bull markets, it drops to 40 to 1 or lower. In 2011, it hit 31 to 1. In 1980, it briefly touched 17 to 1. So if gold is at $2,650 right now and the ratio reverts to just 60 to 1, silver needs to be at $44. If it goes to 40 to 1, silver hits $66. And if we see a 2011 style panic into silver, we're looking at $85 to $155 per ounce. Now I know what you're thinking. That sounds insane. That sounds like hopium. That sounds like the kind of prediction that gets laughed at on financial Twitter. But let me give you the fundamental backdrop that makes this not just possible, but probable. Global silver supply is in deficit. We're consuming more silver than we're producing. In 2023, the deficit was 142 million ounces. In 2024, it's projected to be even larger. And this isn't a one-year anomaly. We've been in deficit for 3 consecutive years. The above-ground stockpiles are being drawn down. The COMEX inventories are at multi-year lows. And industrial demand is accelerating, not slowing down. Solar panels alone are consuming over 200 million ounces per year. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure requires silver. AI data centers require silver. The green energy transition that every government on Earth is pushing requires massive amounts of silver. And here's the problem. You can't print silver. You can't create it out of thin air. You have to mine it. And silver mining is not increasing fast enough to meet demand. But there's something else happening that nobody's talking about. The paper silver market is starting to crack. The COMEX has 350 million ounces of registered silver. That's silver available for delivery. But the open interest, the number of contracts that could demand delivery, represents over 900 million ounces. That's a 2.5 to 1 leverage ratio, and it's getting worse. Every month, more contracts are standing for delivery. Every month, more physical silver is leaving the COMEX vaults. And every month, the ratio gets more dangerous. You want to know what happened in 2011? The paper market broke. Not completely, but enough to cause panic, enough to cause a short squeeze, enough to send silver from $27 to $49 in a matter of weeks. And the setup today is even more precarious because the physical shortage is real this time. In 2011, it was mostly a momentum trade. Today, it's a fundamental supply crisis masked by paper market manipulation. Let me tell you about what's happening in India right now. India is the second largest consumer of silver in the world. In 2024, Indian silver imports hit record levels. We're talking about a 50% increase year over year. Why? Because the Indian rupee is weakening, because inflation is accelerating, because Indian citizens don't trust their banking system. And when Indians buy silver, they don't sell it. It goes into jewelry, it goes into temples, it goes into family vaults. It's gone from the market, permanently. China's doing the same thing. Chinese silver imports in 2024 are up 35% year over year. The Shanghai Gold Exchange is seeing record physical delivery volumes. And here's what's fascinating. The premium for physical silver in China is running 8% to 12% above the paper price in New York. That's called backwardation. That's what happens when the physical market is tighter than the paper market. That's what happens right before a price explosion. Now let me connect this to what's happening in the currency markets. The dollar is in trouble. I'm not saying it's collapsing tomorrow. I'm saying the world is slowly, methodically, deliberately moving away from dollar dominance. The BRICS nations just announced a new payment system that bypasses SWIFT. Saudi Arabia is now accepting yuan for oil sales. China and Russia are settling trade in their own currencies. And every central bank on earth is buying gold at record levels. In 2024, central banks bought over 1,000 tons of gold. That's the third consecutive year of record purchases. Why? Because they see what's coming. They see the debt spiral. They see the currency debasement. They see the end game. And when central banks are buying gold at these levels, silver always follows. Always. Because silver is gold's little brother. It's more volatile, it's more explosive, and it's more accessible to retail investors. Speaking of retail investors, let me tell you what's happening in the ETF market. The largest silver ETF, SLV, has seen consistent inflows for 6 consecutive months. That's institutional money. That's smart money. That's the kind of accumulation that happens before major moves. But here's what's even more interesting. The premiums on physical silver coins and bars are running 25 to 40% above spot price. American Silver Eagles are selling for $38 to $42 when spot silver is at $31. That's a massive premium. That's what happens when physical demand overwhelms supply, and the mints can't keep up. The US Mint, the Royal Canadian Mint, the Perth Mint, they're all running behind on orders. Lead times are stretching to 4 to 6 weeks. Dealers are rationing inventory. And this is happening when silver is still relatively cheap. Imagine what happens when silver breaks $35, then $40, then $45. The FOMO will be unlike anything we've seen since 2011. Now, let me address the elephant in the room. The manipulation argument. Yes, the silver market has been manipulated. JP Morgan paid nearly $1 billion in fines for spoofing the precious metals markets. Deutsche Bank settled for manipulation charges. The evidence is overwhelming. But here's what people miss. Manipulation only works in a market with adequate supply. When physical supply gets tight, manipulation becomes impossible. You can't suppress the price of something that doesn't exist. And that's where we are right now. The paper market is still trying to control the price. But the physical market is starting to revolt. The premiums are proof. The delivery demands are proof. The inventory drawdowns are proof. And when the paper market finally loses control, the price discovery will be violent and swift. Let me give you a historical parallel that's even more relevant than 2011. In 1979, silver was trading around $6. By January 1980, it hit $50. That's a 733% gain in less than a year. What caused it? The Hunt brothers tried to corner the market. They accumulated massive amounts of physical silver. They stood for delivery on COMEX contracts. They exposed the fractional reserve nature of the paper market, and the price went parabolic. Now, I'm not saying someone's trying to corner the market today, but I am saying the same dynamics are in play. Physical demand is overwhelming paper supply. Industrial users are getting nervous. Investors are waking up to the supply deficit, and the COMEX is running out of silver to deliver. Here's something most people don't know. In 2023, there were multiple delivery failures on the COMEX, not publicized, not reported in the mainstream media. But if you dig into the data, you'll see contracts that were settled in cash instead of metal. That's a red flag. That's what happens when the warehouse doesn't have the silver to deliver. And it's happening more frequently. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I put together a free guide that covers exactly how to get physical precious metals into your retirement account without tax penalties. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings with real assets. All right, back to where this price is headed. The technical target for this breakout is $58 to $65. That's based on the height of the cup and handle pattern projected from the breakout point. But that's the conservative target. That assumes a normal, measured move. If we get a short squeeze, if we get a supply panic, if we get a currency crisis, all bets are off. We could see $80, $100, or higher. And here's why I think we're going to see the explosive scenario rather than the measured one. The macro backdrop is worse than 2011. In 2011, the Fed had just finished QE2. They were talking about normalizing policy. Today, the Fed is trapped. They can't raise rates without crashing the economy. They can't lower rates without reigniting inflation. They're stuck, and the market knows it. The national debt is $36 trillion and growing by $1 trillion every 100 days. Social Security is going insolvent. Medicare is going insolvent. Pension funds are underfunded by trillions. And the only solution anyone's proposing is more money printing, more debt, more debasement. And when that happens, hard assets win. Gold wins. Silver wins. Real estate wins. Stocks denominated in depreciating currency might go up nominally, but they lose in real terms. Let me show you what's happening in the mining sector. Silver miners are trading at valuations we haven't seen since 2015. The average silver miner is trading at 0.8 times book value. That's absurd. That's saying these companies are worth less than their assets. And the market's doing that because it doesn't believe silver's going higher. But when silver breaks out, these miners are going to explode. We're talking about 3x, 5x, 10x moves in individual names. I'm watching companies like First Majestic, Hecla Mining, Pan American Silver. These are established producers with real assets, real cash flow, and real leverage to the silver price. When silver moves from $31 to $50, these stocks don't go up 60%. They go up 200% to 300%. That's the leverage you get in the mining sector. But you have to be positioned before the move. Once silver's at $45, the easy money in the miners is gone. Now let me talk about timing, because that's what everyone wants to know. When is this going to happen? And the honest answer is, I don't know exactly. Nobody does. But I can tell you what the catalysts are, what the triggers could be. Catalyst number 1, a major delivery default on the COMEX. If a large institution stands for delivery and the COMEX can't deliver, the price will gap up overnight. We're talking about a 20 to 30% move in a single session. Catalyst number 2, a currency crisis. If the dollar breaks down, if the euro collapses, if the yen implodes, money will flood into precious metals. And silver, being more accessible than gold, will see disproportionate inflows. Catalyst number 3, a geopolitical event. War in the Middle East, conflict with China, a terrorist attack. Anything that creates fear and uncertainty sends money into safe havens. And silver is increasingly being viewed as a safe haven, not just an industrial metal. Catalyst number 4, a supply shock, a major mine closure, a natural disaster in a key producing region, a labor strike. Anything that disrupts supply when demand is already tight will send prices soaring. And here's the thing. We don't need all 4 catalysts. We only need one. And any one of them could happen tomorrow, next week, next month. The setup is complete. The fundamentals are in place. The technicals are screaming. All we need is the spark. Let me tell you what I'm doing personally. I'm accumulating physical silver. Not paper silver, not ETFs, not mining stocks. Physical metal. Coins, bars, rounds. Stuff I can hold in my hand. Stuff that can't be hacked, can't be confiscated, can't be devalued by a central bank. And I'm doing it now, while premiums are still reasonable, while supply is still available, while most people are still asleep. Because here's what I learned in 2011. When silver starts moving, you can't get it. The premiums explode. The wait times extend to months. The dealers run out of inventory. And you're stuck chasing price, paying $45 for silver that you could have bought at $30 6 weeks earlier. I'm also positioning in the miners. Small positions in quality names with strong balance sheets and low production costs. Companies that will survive if silver stays flat, but will explode if silver runs. And I'm using a barbell strategy. Physical metal for safety and wealth preservation. Mining stocks for leverage and upside. But here's what I'm not doing. I'm not using leverage. I'm not trading futures. I'm not trying to time the exact bottom. Because in a market like this, being early is the same as being right. The risk of missing the move is far greater than the risk of being a few dollars too early. Let me give you some perspective on what a move to $50 silver means in real terms. If you own 1,000 ounces at $31, that's $31,000. At $50, that's $50,000. That's a $19,000 gain. If you own 5,000 ounces, that's a $95,000 gain. If you own 10,000 ounces, that's a $190,000 gain. And if silver goes to $75 or $100, multiply those numbers accordingly. But it's not just about the gains. It's about the protection. Because while silver's going up, your dollars are going down. Your purchasing power is eroding. Your savings are being debased. And silver is the hedge. It's the insurance policy. It's the asset that maintains its value when everything else is falling apart. Now, I want to address the skeptics. The people who say silver's been a terrible investment for 13 years. The people who say it's a barbarous relic. The people who say you can't eat it, can't spend it, can't use it. And they're right about one thing. Silver's been in a consolidation for over a decade, but that's exactly why the opportunity is so massive right now. Markets move in cycles. Long periods of consolidation are followed by explosive moves. Long periods of boredom are followed by intense volatility. And we're at the end of the consolidation phase. We're at the beginning of the explosive phase, and the people who recognize that, who position for it, who act on it, are going to make generational wealth. Let me show you one more thing. The Commitment of Traders Report. This is data published by the CFTC that shows the positioning of different market participants. And right now, the commercial traders, the big banks, the market makers, they're net long silver. That almost never happens. Commercials are usually short because they're hedging production. But right now, they're long. That means they're expecting higher prices. That means they're positioning for a move. And the large speculators, the hedge funds, the momentum traders, they're not even in the market yet. Their positioning is neutral to slightly short. That means when silver starts moving, they're going to have to chase. They're going to have to cover shorts and go long. And that's fuel for the fire. That's what creates parabolic moves. I've been analyzing markets for over 2 decades. I've seen bubbles. I've seen crashes. I've seen manipulation. I've seen capitulation. And what I'm seeing in silver right now is the setup of a lifetime. It's the kind of opportunity that comes once every 10 to 15 years. And the people who recognize it, who act on it, who have the courage to position before the crowd, are going to be rewarded beyond their wildest expectations. But you have to act. You have to make a decision. Because in 6 months, in a year, when silver's at $55 or $65 or $75, you're going to look back at $31 silver and kick yourself for not buying. You're going to see the premiums at 50% over spot and realize you missed the window. You're going to watch the miners up 400% and wish you had taken a position. The technical setup is identical to 2011. The fundamental backdrop is even more bullish. The supply deficit is real. The currency crisis is unfolding. The geopolitical tensions are escalating. And silver is sitting at the exact same inflection point it was at in August 2010, right before it went from $18 to $49. This is not financial advice. I'm not telling you what to do with your money, but I am telling you what I'm seeing. I'm telling you what the data shows. I'm telling you what history teaches. And I'm telling you that opportunities like this don't come around often. And when they do, you have to recognize them. You have to act on them. You have to have the conviction to position before the crowd. Because the crowd is always late. The crowd buys at the top. The crowd panics at the bottom. The crowd follows the mainstream media, which is always wrong at turning points. And if you want to build real wealth, if you want to protect your family, if you want to position for what's coming, you have to think differently. You have to act differently. You have to be willing to be early, to be contrarian, to be right when everyone else is wrong. Silver at $31 is a gift. It's a generational opportunity. It's the setup we've been waiting for since 2011. And the clock is ticking. The breakout is confirmed. The fundamentals are aligned. The technicals are screaming. And the only question left is whether you're going to act on it or watch from the sidelines as the biggest precious metals bull market in history unfolds without you.